Hello and welcome to Simplicity in Stocks. In these videos, we dive into the important foundations of investing. This video will cover the most dangerous myths in investing that can harm your portfolio. Every investor dreams of getting rich in the stock market. Everyone who has committed large sums of money or is planning to do so believes their investment portfolio is their ticket to a rich life. They are not wrong. After all, long term investing is a proven path to wealth creation. But there is a big difference between using a cautious, disciplined investing strategy and an aggressive one. The former holds promise of creating wealth that can last generations. The latter carries the risk of destroying your portfolio. Now, just to be clear, there is nothing wrong about adopting an aggressive investing strategy if implemented properly. Some of these can and do work, but these strategies tend to be too sophisticated for most investors. Using them without sufficient knowledge and experience can lead to heavy losses. Unfortunately, this is exactly what happens far too often. This is why it's better to stick to a simple, time tested strategy like value investing. However, many investors make mistakes even when implementing simple strategies. This is due to a lack of knowledge of the investing basics, but this is easily preventable. You see, most investing mistakes stem from just a few investing myths. These myths have been around for a long time and they have destroyed many portfolios. If you can just avoid these mistakes, you will be ahead of most stock market investors. In fact, it wouldn't be too much of a stretch to say that avoiding just 5 investing myths will ensure the health of your portfolio. Now, do keep in mind that this video is for information purposes only. It is not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. To get rich in the stock market, you need to first ensure that you don't lose money. This is the first investing rule of Warren Buffett. His second rule is not to forget the first rule. Sadly, many investors do forget. 1. It's possible to get rich quickly in the stock market. This is perhaps the most dangerous myth of all. It's a common belief among many investors, even some experienced ones. They believe the stock market offers them a path to get rich quickly. What they don't seem to understand is that it's only possible to get rich quick in the stock market by committing huge amounts of money in only one or just a few stocks, and then pray that it all works out. Those who follow this path often choose to play in the FNO segment to increase leverage. They hope this will boost their return on investment and thus make more profits at a faster pace. Unfortunately, most investors who put all their money in just one stock or very few stocks to increase their returns with leverage end up losing money. On this path, all it takes is for one call to go against you at any time to destroy your portfolio. You may get lucky for a while, but eventually your luck will run out. 2. Penny stocks are the best way to get rich. This is another common investing myth. Many investors have made their fortunes in the stock market without investing in a single penny stock their entire lives. But this myth refuses to die. Many retail investors seem to think penny stocks are their ticket to big profits. Now, they are not necessarily wrong. Penny stocks are known to rise spectacularly. It's this sharp rise that catches everyone's attention. In a bull market, more than a few penny stocks will do well. Some will most certainly become multi-bagger stocks. This convinces retail investors that penny stock investing is their best bet to get rich. What they don't realize is that investing heavily in penny stocks is perhaps the best way to destroy their portfolios. The reason for this is simple. Most stocks in the market have low market capitalization, that is, they are tiny stocks. Not all of them are penny stocks, but most of them are. Their fundamentals are dubious. Their management quality is doubtful. These stocks are very vulnerable to the actions of stock market operators. Only a few of them are even worth considering as long term investments. And most investors won't find these needles in the penny stock haystack. Unless you plan to devote a huge amount of time and effort to study these tiny companies and are willing to take a massive risk with your money, it's best to avoid them. 3. You need leverage to make it big in the stock market. Many investors and traders in the stock market are against using their own money beyond a point. They prefer to play with borrowed money, that is leverage. They do this via the F&O segment or by taking loans from their bank or broker. They believe the less money they have on the line, the better it is. To prevent damage to their portfolios, they employ many risk mitigation tools like stop losses and money management. These are usually investors with some experience and sophistication. However, the risk here is very real. While one loss may not wipe out their portfolio, a long losing streak will. And if you invest for long enough, a long losing streak is inevitable. 4. You only need a few good stocks. This, strictly speaking, is not an investing myth, but it's important to include it in this list. Once investors acquire a level of knowledge, they realize something important. Most of their gains come from just a few stocks. They also realize this is the case with other investors too. Thus, they wonder if they only need a few good stocks in their portfolio. After all, why go to all the trouble of building a 20 stock portfolio if most of the profits will come from just 2 or 3 stocks? Why not look for those few stocks that could turn into multi-baggers? Isn't this the logical thing to do? Well, yes and no. It is true that only a few stocks will provide most of your investment returns. This is true for every investor, even Warren Buffett with his investment in Apple. In the Indian market, we know the biggest contributor to the late Rakesh Jhunjhunwala's portfolio was Titan Company. But this doesn't mean you can just go out there looking for the next Titan and put all your money into it. By their very nature, these are very rare stocks. The chances that you will find them are slim. And even if you find one, you might end up selling it too soon, or perhaps hold on to them long after their fundamentals no longer justify it. Then there is also the risk that you might mistake a fundamentally poor stock for the next Titan or the next Infosys and put a lot of money into it. Sadly, such cases are very common. Always be suspicious of anyone calling a stock the next big thing. 5. Small caps and micro caps do better than large caps. This is a myth because the statement is incorrect. Here is the correct statement. Fundamentally strong small caps and micro caps with good growth prospects run by honest and competent management do better than large caps on average and only in the long term. All aspects of this statement need to be true for it to be true as a whole. By all means, invest in small caps and micro caps. The best microcap stocks and the best small cap stocks can be very rewarding. But please understand that you should pick only those that are fundamentally sound. They should have a strong growth runway ahead of them, and the management's competence and integrity should be beyond question. If all these points are not checked, then you are investing based on a myth, and it could destroy your portfolio. We hope this video has provided you with the knowledge to ensure that you don't fall prey to these 5 common investing myths. Stay clear of them to keep your portfolio safe. Thank you for watching.